US manufacturing contracts, keeping the Fed on course to cut next month. But Fed speakers see only gradual falls. Those comments drove Treasury yields up and stocks down this morning, and PMIs in Australia and Japan pick up. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ Head of FX Research Mahjabeen Zaman looks ahead to key speeches today by the heads of the US and Japanese central banks.
There is a little bit of a disconnect, though, between the Fed's guidance and market pricing for rate cuts. And so clearly, dollar, we think, has fallen pretty sharply, and there might be room for a firming of the dollar index if Powell is less dovish than the market expects.
But first, in 5 and 5 with ANZ, US manufacturing contracted in August at its fastest pace this year, bedding in expectations the Fed can cut from next month. But Fed speakers were wary this morning about fast cuts, and that drove US bond yields up 7 to 8 basis points and saw US stocks fall between 0.5% and almost 2% for the Nasdaq. ANZ Head of G3 Economics, Brian Martin, says from London overnight that PMI data showed manufacturing weaker than services and reinforced indications for a soft landing.
It is the second month that manufacturing has been below 50, and the index is flagging that manufacturing would benefit from lower interest rates by the Fed. We anticipate that the Fed will cut rates 25 basis points in September.
Number 2. Australia's composite PMI, the Performance and Manufacturing Index, rose back into expansionary territory in August to a 3-month high. ANZ economist Maddie Dunk says a key reading was that employment indicators picked up, particularly in the services industries.
I think that the RBA would welcome that stronger reading in employment in these latest PMIs because they have acknowledged that there is a risk we see a sharper than expected deterioration in the Australian labour market. We expect that it will be a pretty modest easing in the labour market from here. We expect that the unemployment rate will peak at 4.4%. The other thing that the RBA should be happy about in this PMI reading is the fact that we saw selling price inflation come off, and that's despite the fact input prices grew at their fastest pace in more than a year.
Number 3. Japan's composite PMI edged up to a 15-month high of 53 in August. ANZ FX analyst Felix Ryan says while the output price measure fell slightly, input prices rose to their highest level since April 2023.
With price indices still remaining largely elevated, this does suggest that inflationary pressures locally are building for Japan and does support our view that the Bank of Japan are not done with raising interest rates this year. Domestic demand, especially in services, does also seem quite firm and is building momentum, and this may be a reflection of the manifestation of the wage price spiral and a rebound in private consumption that the Bank of Japan have been looking for.
Number 4. The Bank of Korea held its policy rate at 3.5% yesterday, as expected, but turned more dovish as a majority of members said they were open to a rate cut in the next 3 months. ANZ economist Crystal Tan says the governor acknowledged that inflation dynamics pointed to an ability to cut rates.
The concern, though, is that a rate cut could risk overheating the housing market and raise FX volatility. So the main constraint holding the Bank of Korea back from a rate cut is financial stability concerns. Accordingly, the impact of macroprudential measures set to kick in from September to curb the rise in house prices, particularly in the capital region, will be key to watch. Our base case is still for the Bank of Korea to deliver a single 25 basis point rate cut this year, likely in October.
Number 5. Malaysia's annual CPI inflation rate was unchanged at 2% in July, with core inflation staying at 1.9%. ANZ economist Arindam Chakraborty says that a petrol subsidy removal will have a greater impact on headline inflation than a recent diesel subsidy cut.
Even so, the inflation outlook remains manageable. On the other hand, the growth momentum has been quite strong, with the Q2 GDP recording a higher than expected growth of 5.9%. Therefore, balancing the two, we think BNM will keep the policy rate unchanged at 3% in 2024.
Arindam Chakraborty there. Now, on our bonus deep dive interview, ANZ's Head of FX Research, Mahjabeen Zaman, outlines what to look out for in key speeches today and overnight by the governors of the Bank of Japan and the US Federal Chair, Jerome Powell, and the potential impact on their two currencies.
The sharp decline in the US dollar has likely gone too far, given that expectations of more than 625 basis points rate cuts, that's a total of about 160 basis points of rate cuts up to March next year, do seem a little bit unfounded. We do see two risk events today that could drive a turnaround of the dollar, especially if we look at it against the yen. We have Bank of Japan Governor Ueda's appearance before the Diet and Federal Reserve Chair Powell's speech at the Jackson Hole Symposium. To start off with, we think Ueda's appearance in Japan's parliament will possibly be meaningful for markets, as he will be sharing his thinking behind the rate hike that we saw in July, and he will probably discuss the inflation outlook. Now, historically, Bank of Japan's commentary has been neutral to dovish, and what we have seen is that comments around rate hikes often stress that policy needs to remain accommodative and rate hikes gradual. Now, I think market participants will be listening carefully to see if Ueda tilts towards a more gradual normalization of interest rates in a way that is less hawkish or slightly dovish. If that, of course, happens, clearly that should see a shift higher in dollar yen.
So we have US Federal Reserve Chair Jerome Powell speaking at Jackson Hole. What are we expecting to hear from him?
We think Powell is likely to address short-term policy outlook and possibly just reiterate his comments from the July FOMC meeting, where he opened the door to a possibility of a rate cut in September. Of course, since then, both inflation and employment data have supported expectations of a 25 basis points rate cut, which we also expect up in September. And more so, the FOMC July meeting minutes we saw this week also support a September start to the Fed easing cycle. We don't think that Powell will discuss the size of cuts at Jackson Hole, especially as August US payrolls are out later in early September, and this is well before the September FOMC meeting. Now, the recent rebound in ISM services, particularly the employment sub-index and retail sales, point to a soft landing environment. So clearly, this does not support or does not drive any reason for larger than 25 basis points rate cuts. So the talk around 50 basis points of rate cuts in September on the back of the non-farm payrolls number we saw previously, I think that's been sort of priced out now, given we think we are going to be possibly facing a soft landing and not a hard landing environment. There is a little bit of a disconnect, though, between the Fed's guidance and market pricing for rate cuts. And so clearly, dollar, we think, has fallen pretty sharply, and there might be room for a firming of the dollar index if Powell is less dovish than the market expects at his meeting.
Mahjabeen Zaman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, August the 23rd. Catch you next week with the key messages from those two speeches from the head of the Japanese and US central banks. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.